It's going to be a couple seconds. We are live. We are live on Facebook with Peggy Urieff of Coldwell Banker Residential Real Estate.
Hello, hello. Well, this is an event for my clients. We've had a lot of questions coming up regarding all things COVID-19 and how it is affecting the market. And so I wanted you to get to experience, if you haven't met Ken McKee already. He is a wealth of knowledge about all things lending. And so Ken, why don't you tell us a little bit about your background, how you got into lending?
Oh, that's a great one. Cool. Hey, my name is Ken McKee. I work at Movement Mortgage in Roseville. I've been in the industry for 15 years. How did I get in the industry? I got in the industry because I moved from the Bay Area, from San Jose to Rockland back in 2002. And a buddy of mine, which is kind of the way it works out a lot of times, right? I know this guy, right? I've got a friend who was a cycling buddy who did mortgages, and he did my loan. And we closed late. The interest rate I got was $0.25% higher than what he told me it was going to be. And I had to bring $3,000 extra to the table to make it work, to close escrow. And I knew that he was doing well. And I thought, if this guy is doing good, if I just honor my word to people, then I'm going to kill it. And so it was an interesting time. I was in the I was in the amidst the .com bubble, and I was in telecom and technology. And it was just a good way to move. You know, there's a few other little pegs in it, but bottom line is I love working with people, and I love helping people find a solution to their problems. And I thought it would be a really cool way to doing it. So that's why I got it.
And you've got a lot of experience working in up and down markets, as we've had a lot of different changes amongst real estate. Totally. So this actually doesn't seem as big of a deal as what we went through before, right?
No, this is wow. No, look, I'm not going to minimize it. There's a lot of pain going on right now for a lot of people. That look, we have more people not working than we've ever had. However, I've never seen the government step up with this kind of support, if you will. Like, there was no support for anyone who lost their jobs in 2006, 7, 8, right? And you know, like as an example, you know, my wife quit her job August of 2007. Our son was like 5 months old. She quit her job the same month that, like, the Implodometer, if you ever remember, the Implodometer was this website that you could see how many mortgage companies were going out of business, like every day. And so we lost all of her income, and then I lost half of my income, all within a month. And there was no bailout program. There was nothing like that. So this is a government, you know, mandated shutdown. And so the government feels the need of supporting people. So we definitely are not seeing the things we saw back then, for sure.
But there has been quite a bit of changes. I mean, things are changing every couple of days regarding lending guidelines. And so it's something to keep up to date on. I think the biggest question that I've gotten from clients recently, you know, they've had, you know, maybe they've gotten a 30% cut in pay, or I just got a call from a client that was furloughed, and they're like, hey, maybe we should just not make our mortgage payment. We hear that, you know, that forbearance deal, and they're also wanting to move to the area, sell their home, and buy in the next, you know, once the furlough is up in a couple of months. And I told them, make your mortgage payment if you can, right?
Yeah.
So what are you hearing about that?
Yeah, 100%. Like, you know, it's interesting. On one hand, you're hearing that the package that was passed in Congress and in the Senate, or the House and the Senate, allows homeowners to not make their mortgage payment for 6 months. And I even heard Ben Carson, who's the head of HUD, the Department of Housing and Urban Development, talk, and he was interviewed a couple of days ago, and I heard it this morning. And he said, yeah, we're okay with taking those, like, up to 6 months of payments, and we'll put them on the back of your mortgage. And then when I go to HUD's website this morning and look at it, HUD very quickly says, you know, hey, if you are wondering what aid you can have, call your servicer. And so I think what a lot of people don't understand is that you have the government, but you also have you have private companies that are actually servicing the loans, and those they're the ones that determine the rules. So whether you or everyone will be able to get a forbearance if they need it. So just put that out there. So if you are not able to make your payments, you've exhausted all your resources, you have no savings, and you're going to miss a mortgage payment, it's there for you. However, like anything, there are consequences for every action, and it can be a good consequence or a bad consequence. In this case, if you just don't make your payment, I saw a forbearance agreement yesterday that said it was just inked like in late March, and it said your April 1st payment, 0, your May 1st payment, 0, June 1st payment, 0, July 1st payment, $8,827.
Mhm.
So what are you going to do? Are you going to be able to make that? And if you don't make that, then you risk defaulting, which could lead to negative credit and reporting. It could lead to not being able to get a loan in the future. So I think what you started this out with, and I totally rabbit holed on this one, but bottom line is that if you go into forbearance or even inquire about a forbearance with your current lender, there is a chance you will not be able to do a loan in the next 6 months, year. I mean, it really isn't clear at this point.
Yeah. Yeah. And that's what I'm hearing as well. I mean, I like Dave Ramsey put out what he calls the 4 walls, the things that you pay for. And number 1 is food. Number 2 is your mortgage, utilities, and gas for your car, insurance. And so if you can make those obligations, those are the ones to make first, because I anticipate there's going to be credit hits. And if you do want to buy in a couple of years, or you want to refinance, gosh, it's like a ridiculous, incredible time to refinance with interest rates. The last time my husband and I refinanced, I think it was when our 4th child was born 7 years ago, and rates were at 3.5. And I said, Jarrett, we're never going to get a 3.5 interest rate for 30 years. We need to refinance now, because that over the life of the loan is going to make a huge difference in building equity and money for our family. And look at where we're at now. I mean, I did not anticipate that interest rates would get to these levels again. So people, I mean, that have, I can just look at my neighbors around me, and everyone still has their job. They're just working from home. There's a lot of those people in the economy, plus they're now getting these stimulus checks in the mail.
Yeah, even people that are on unemployment, we're going to see numbers again tomorrow morning, but last week it was, I want to say that it was 10 million people that filed for unemployment, and it may have been 6.6. I don't want to exacerbate it, but I think over the last 3 weeks has been like north of 16 million people apply for unemployment. But all you have to do is fill in COVID-19 for the source or the reason, and you get a set amount of money based on your previous year's earnings.
Mm-hmm.
If this continues for months, yes, it may be more of a problem. If it happens, if we get through this in the next month, 2 months, where we're back to work, most people are going to be made, and I know there's always going to be someone that says that's not me, but most people are going to be made mostly whole.
Mm-hmm.
If that makes sense, where they're not going to need to miss a payment. And it's not a freebie. It's not a handout. There's always going to be a consequence for it. Nothing's free, right? So, like I think I was telling someone earlier, we funded a loan for a couple last month, and the wife is an attorney. The husband has a job that's not been affected. And literally we funded the loan, and within a week, I got a call saying, hey, who's our new servicer? And we asked, well, why would you, I'm not sure yet, but what springs that question up? And they said, well, we want to take advantage of the forbearance. And I'm like, is anything wrong? And they're like, no, but I just want to take advantage of it. And it's not a government handout. This is not, you're not getting a free cell phone or something,
Yeah, it's just tacking it onto the back of the loan, or doing a balloon payment in 3
months
or yeah. And so,
if you can't make a payment now, you're not gonna be able to make an $8,000 payment in 4 months.
Mm-hmm.
So I think maybe it's worthwhile even talking about like, what are the alternatives, right? What could you do to
yeah, to bridge that gap so that you're not, doing a forbearance. I mean, not that we want people to get into credit card debt, but if this is something that you're going to bounce out of, and you have a line of credit that you can pull from to pay your mortgage, so you don't have, the issue of forbearance if you plan to buy in the future, or, get into one of those tough situations where you're going to have a late on your credit. This is a time to preserve credit, because especially, I was just reading, it was like 8.2 million Americans right now could save upwards of $260 a month off of their mortgage payment if they just refinanced.
Right.
And so that is a big deal for families. I mean, if you spread $260 a month out over 30 years, not that everyone's going to be on, stay for 30 years in the same house, but my family does. I mean, my parents are still in the house. I mean, that's a savings of $93,000 of equity that you're gaining, or money that you can invest elsewhere. So I would say, anybody who can refinance if their rate is higher, this is a time to preserve your credit. What are rates at right now today?
For purchases, so is it worthwhile talking about like what's not normal right now with mortgages? So what's not normal right now with mortgages are jumbo. So anything over in the Sacramento area, it's 569,250, and above that is a jumbo. And so right now, jumbos are pretty much limited to 700 plus FICO score, 20% down, or 20% equity. If you're doing a refinance, a lot of companies have really jacked up their margins for their what they call the loan level pricing adjustment for cash out. And so you might see rates that can be even as much as 0.5%, a quarter to 0.5% higher than it would be normally. So that's not normal. And a lot of companies are limiting their cash out to maybe like 70% loan to value, like total, right? So loan to value is how much is the loan compared to the house's value. So that's not normal. On the first time homebuyer front, sadly, like all the bond programs are pretty much on hold. So CalHFA, GSFA Platinum, a lot of the ones where people can get grant money to be able to offset down payment and closing costs are gone. And a lot of that is because the servicers that do those loans have decided to pause and say, I'm not willing to take on any more risk, because if we have maybe up to a 10 to 20% unemployment rate over the next couple of months here, the chance of someone defaulting on their loan is higher. And so, and when you put little money down, right, you have lower credit scores, which a lot of people do that do the first time homebuyer programs, those tend to default faster, those loans. And so the other thing that we're seeing is FHA and VA, we're seeing a little higher on the price, on the rates. They're still in the threes. So it's not like the world has come to an end. It's amazing.
Yeah, crazy.
But it's higher than conventional for the same price or same price range. And we're also seeing a squeeze right now on low FICO score and high loan to value. So people that put little money down but have really low FICO scores, those programs are just being phased out. So a lot of companies, it's not even that the agency like Fannie Mae, Freddie Mac, or Ginnie Mae, it's not even their guidelines. It's more of the servicers that are going to have to make those payments to the bondholder, even if the mortgagee, the person writing the mortgage check that owns the house, if they don't make a payment, the servicer still has to make the payment to the bondholder. And so you're seeing companies that are servicing saying, hey, if we're going to do this and we're going to take on this risk, we're going to raise our credit score. I've seen companies increase their minimum credit score to 640. Some have gone to 680, and there are some locally that have even gone up to 700 as a minimum. Like Chase just came out yesterday and said, across the board, we're not doing any loan under 700 FICO score. Yeah. So with all that said, we're still like mid threes for interest rates, and like right around 3% for a 15-year, which is historically incredibly fantastic.
Yeah, I mean, I wouldn't personally lend out my money over 30 years to anyone at 3.5% interest rate. I mean, no, it does. It's not. It's not something to be doing. But that is like a big benefit right now to the market for people to lock in those low interest rates and reduce their payment or keep the same, horizon on the amortization of the loan. So it's not like they're extending the loan out another 30 years, but maybe you have 25 years left and redoing the loan to 25, but lowering the interest rate is a big one.
Yeah.
Catherine has a question. Does it make sense to try selling now if you're in a hot area like Roseville, because the market might be glutted once the stay-at-home order is down? So let me kind of tell you how the stay-at-home order has kind of affected the Sacramento real estate market. So basically, realtors weren't considered essential. People like Ken was deemed an essential worker right off the bat, but it took oh yeah, don't get too excited. But you also sit behind a desk most of the day, and I am out in the field. And so you can see why they would do that. So realtors, we are now essential service providers. We're just doing showings differently. In Placer County, it has to be a vacant home. Only 2 people can view it. We've got to have booties, gloves, sanitizing wipes, disclosures signed. So, but what we're seeing from the numbers, and it's something that I'm pulling data every week, because a lot of the things that have closed so far, they were, people actually saw the homes live in person before the shelter in place. So it's something to keep monitoring. Now we do have limited ability to show property. But, for the past couple of weeks, a lot of it, unless somebody wasn't following the guidelines, was just using video, which I've used for 7 years on all of my listings anyways. So it didn't really change things for me. But in our whole market, 1,000 homes in the Sacramento area, the sellers just took it off the market and they said, hey, I don't want people coming through my home, or I just want to, stop and stay where I'm at for the time being. So what happened is we have a lot less homes on the market. So but our pendings are still going pretty strong. The latest stat is 42% of our properties got multiple offers. So that's a huge amount. So I think once the shelter in place, once people get more used to the market, there's going to be a lot more properties on the market. So if somebody wants to, continue to play in the market, I think you've got scarcer inventory, but you still have buyers, especially things that are in the lower price points. Like Ken was talking about jumbo loans. I mean, stuff that's below 550 in our marketplace. I mean, it's clipping along, it's moving. So, if our normal, let's say, spring season gets pushed off, as they suspect, till the end of summer and the fall, you're going to have more sellers on the market. And there are some people that have to sell. I mean, it's not most moves are not, there's some sort of driving factor to their job or their lifestyle or relational that makes people need to move. So those will still happen by and large. So I am advising my clients, if you want to show your house vacant, I put 2 homes on the market yesterday. We've already gotten lots of calls for showings. They're being shown vacant, and I expect we'll get multiple offers, and they'll both be pending next week. Answer that question.
I'd love to hear, really, Catherine, if you want to send another question to Peggy, I'd love to know whether you are wondering if the market's going to drop a little bit later because we have more sellers, or if you think it's going to go up, and that'd be interesting to hear what your thoughts are. But I'll tell you what I think. I think that our lives, there's certain things that happen to us over the course of our lives that change the way we do business, and it changed the way we live. It's funny, my son's doing a summative, I think they call it, for school, where they have to, it's like basically he's going through different events and he has to talk about how these things affect our lives. And it was cool to talk with him this morning about, like, hey guys, like, COVID is actually changing our life and what we think is normal and how we interact with other people. And I think we're going to see a lot of companies, like in the past, we've benefited from a lot of the tech companies having their employees able to live here and work remotely. because they had the technology to do that. And that's kind of how they are. They love embracing new technology. And a lot of the standard traditional brick and mortar businesses, if you want to work for a company in San Jose, you got to live in San Jose or in the Bay Area, right? And I think that now that everyone's working from home, if we do this for 2-3 months, and we're already a month and a bit into it, there's gonna be more companies that say it's not so bad. I think this is a way we can attract more talent, and we can have a little lower expense ratio here. So I think we're going to see remote workers more in more industries, and that's just going to benefit, the Sacramento area, and I think that's going to impact our housing prices for the better.
Yeah, I think the thing to watch for is, our figures for buyers, our buyer pool, it's about 17% are coming from the Bay Area or the coast. And Sacramento is the #1 destination market in California for people trying to go from less affordable areas to more affordable area. We're the most popular stop. And I think because of all this remote working, and it's like a crash course for corporate America in Zoom and things that, not everyone used before, that we will see more people being able to move from the Bay Area and have, more affordability for homes and, different quality of life. I would say it's a better quality of life, but it depends who you ask. So, so I think we will see more buyers out of this relocating. One thing just, to think about for, sellers is when you're at home for this time period, if you don't want to put your house on the market right now, this is a great time to be getting your house prepped and ready for market. Because you've got, hopefully, between homeschooling and working remotely or whatever, and not being able to go, that you have time to fix it up. So that's another thing. So we talked about forbearance, we talked about buyers. I think, where some people are getting laid off, there's a lot of people that aren't, and they're now getting the stimulus money, right? And so for some people, it's actually, if the husband is a firefighter and the wife is a nurse, they're probably working overtime, making more money, and now they've got a little bit of stimulus money. So there are a lot of people in the market that I don't think will be financially affected by this. And when Ken and I are writing, and just basically when we work together, prepping a buyer to be the most competitive possible on the market. And we have a very systemized way that, my goal and Ken's goal is to get our clients what they want and the quickest time possible. Because when you are writing and you're in multiple offers time and time again, it's an emotional process, right? And so, having your loan completely approved, where you can write a contract on a house with absolutely no loan contingency. In some cases, depending on what the zip code is and the address, we can get the appraisal completely waived. So when you're competing against 4 offers, Ken and I were competing for a client that was a nurse just a couple of weeks ago. And we were one of 4 offers. We wrote the love letter. We could close in 2 weeks with the loan. We had no loan contingency, no appraisal contingency, and we got the house. So just spending this time making sure that you've got the best game plan to be most attractive in a multiple offer situation is, it makes the process so much easier for everyone, and it gets the job done quicker, right? You can be in it in 2 weeks.
Yeah. I think this is a lot of opportunity. There's opportunity for people. Like, obviously some people are not going to be able to buy right now because, we're working with a guy who's a spin instructor at 2 different, clubs, and they're shut down. So he's not working, right? He's furloughed. So obviously he's a great buyer when he's working. And as soon as he goes back to work, he'll be right back in it and going. But there are other people who haven't been affected. Like you said, there's law enforcement, there's nurses, there's people who just work in a company that is just able to work remotely, and they're functioning as normal. They're not seeing any decrease in sales as a company, and they have more ability to get their offers accepted. And we have this whole, like you mentioned earlier, that 42% of offers were multiple offers.
Multiple in today's market. Yeah.
Right. And anecdotally on our team, I think like in the last month, it's been like 80 to 90% that are multiple offer. We're not seeing any onesie twosies, but the ones that are there. And but well, now let's put it in reference. Like 2 months ago, everything was multiple offer, unless a house has been sitting on the market for 30 days or more and it's just outpriced or overpriced, right? And so, but people that are maybe they got beat out before, we're seeing more VA offers get accepted right now. We're seeing more 3% down, 5% down offers getting accepted. So I think right now there's a huge opportunity for first-time homebuyers or people that have a little bit of money. Grandma wants to give them some money, or they have some set aside, and they can get in with 3 or 5% down on a conventional loan. You know, they don't need a first-time homebuyer program.
Yeah.
And those are the ones I think that benefit actually the most right now.
Yeah. And I think also, people, that have really stable government jobs, part of the change is that California Association of Realtors came out with an addendum that we're supposed to include with purchase contracts that talks about, if the person gets furloughed or laid off during the transaction, even though all of the contingencies are removed on the deal, the seller is not entitled to take their earnest money. So if you're in a multiple offer situation, and if I'm looking at it at the lens of me being a seller and a listing agent, and I'm looking at 3 offers, and there's a spin instructor, there's a teacher, and their offers are pretty comparable. I mean, the teacher's probably still going to have their job, right? So that risk is less during those 30 days or however long the escrow is. You're going to see people that may not have been the sexiest buyers before, for lack of a more PC term, that because of their stability government jobs are going to look better in a multiple offer situation, which, good hurrah for teachers and government workers, right?
100%.
Yeah. So another, besides refinancing, I mean, for buyers, I'm looking at it from an aspect of, I have 5 kids. Ken, you have 3, right?
Yep.
I love California. I was raised in California. I know that, not everyone's going to agree with all the politics and all the whatever. And I have plenty of clients that leave the state. But as far as innovation, weather, I mean, you could travel all over California for the rest of your life and never leave the country and have amazing experiences. I'm looking at the market and saying, with 3% interest rates and with 5 kids, if I can squirrel up some down payments and buy property in California and lock in low interest rates, when my kids graduate from college or whatever, we can gift them, equity in a house, and they can have a better chance of surviving affordability wise in California. Because what the scariest statistics I've heard in real estate for the last year, the scariest thing that I've heard is the chief economist for the California Association of Realtors in January said, we forecast in 2025, there will be more renters in California than homeowners. And that is a huge risk, to live in a very expensive state and to be a renter, which you don't know how much your rent is going to go up next month or the year after that, or the year after that, or the year after that. I mean, me buying my house when I did 16 years ago, I fixed a payment 16 years ago and have stability for my family. I'm building equity. I have a tax write-off for it. I'm freezing my, property tax at a lower level with Prop 13. And I know what my mortgage payment is going to be. There's no difference in, what my rent is going to be 16 years later from then. And everything else has gotten more expensive. My health insurance has gotten more expensive, our food, our insurance, and all of that stuff. So, I know it's like the thing of all generations. They love to step on the generation before and say that they're lazy or they're whatever, or they're entitled. I see so many millennials, and I know millennials can go into their 30s, but I see so many smart millennials, and they love real estate. They love real estate more than any other generation in American history. And they are when I work with first time home buyers that are like 22, 23, and I'm giving them keys, and I'm like, you are setting yourself up to be
Yeah.
able to survive and stay in California, and tell me that in 15 years, their real estate is not going to be double what they paid for it.
Yeah.
I mean, it is,
Yeah.
it's a great state to own real estate in. It's not
Yeah.
Iowa
Well,
or
I
middle
grew up in
America.
Louisiana, so I know what it's like for real estate to not appreciate, you know.
Yeah, I
In
know.
Louisiana in the last 10 years, in California, we've seen nothing but increased, property values over the last 10 years. In Louisiana, seeing 3 boom and bust cycles because of the oil business, right? So we're so blessed here. It's amazing. And it's interesting. I see more kids in their early 20s buying homes because their families understand the importance of buying and locking, like you said, locking in that payment, locking in those taxes when you're in your 20s rather than when you're in 30s. It's just like starting to invest when you're in your 20s versus doing your 30s. It's like double the value at the end, right? And so like we see more what I would call intergenerational wealth plans put together, and grandparents and parents who are willing to give 10,000, 15,000, 20,000 for a down payment and closing costs just to get those kids into a home and fix them in at a payment that's equivalent to what they would rent for, and
Oh,
I think Sacramento, like I read an article last year that Sacramento, now this is a year old, but was the highest big metropolitan area, the highest percent increase year over year rent, for houses. And so we're seeing people that like, I hear all the time, my rent just went up $300, or $250 or whatever it may be. And it's like, well, your payment's never going to go up.
yeah. Yeah. And I mean, I'm just thinking back to, remember Keith a couple of years ago?
Yeah.
Remember him? Great job, young guy. And he was, saved up a little money. And was able to buy a house in my neighborhood. He lives a couple doors over, and really fix himself up for the future. But, there's a lot of ways that you can piece that down payment together. When I bought my first house, we put together 10%, and then we did an 80-10-10. But, you don't even need that. And that was when we were saving up our 10%, the market went up dramatically, right? So we were saving against what the market had appreciated over that time. And I think there is a big misconception with buyers about how much they actually need down. And, with a 3.5% FHA loan, and I mean, tell me if this is different on your side, Ken, but I'm seeing probably 50% of the younger buyers, they are getting a gift.
Yeah, easily, and if you don't have the money for the down now, so the number one thing that I always hear is when I sit down with someone and they want to buy a house and maybe they have to bring a total like 20,000, they want to bring the down payment and the closing costs. Like maybe it's a $400,000 house and they're doing 3% down, right? Maybe they bring 20 grand. And they're like, well, we're going to save the money. I'm like, well, cool. How long is it going to take you to save 20 grand? Well, we think we can save about $1,000 a month. Okay, so we're at a year and a half in. So do you know what prices are going to be on your home in a year and a half? Like it's going to go at least like a year and a half, I would say 7%. We're like about 5% a year is a good steady, even number historically for the state of California. So that $400,000 house is now going to be like $25,000 more. Like you said, you save 20, now the house is 25,000 more. You've actually lost $5,000,
Yeah.
So better to get into a 3% down loan, talk to grandma, talk to mom. I mean, heck, if you've been working in a company for any period of time, you probably have a 401k. And I'm not a huge fan of doing this, but it's better than not owning a home. Then maybe borrow from your 401k and pay yourself back. There's tons of different options.
Yeah. That's what, I dyed my own hair. I ate way too much top ramen. My best friend, Jen, eventually told me, you need to stop dyeing your own hair, Peggy. But when we were saving for a house, we went really strict on it. But I ended up we didn't have enough in the end for closing costs. And so I took a little loan against my 401k, and then we rapidly paid it back. So, that is a good option as well. So, with all of these, multiple offers in the first time buyer arena, what I've been seeing is how much ability for people to step up in the market and get dramatically different properties, right? So you've got like a 1,400 square foot house in Rockland for 400,000, and those people sell their first time home buyer house, they take their equity, and then they move up to 550 and they've doubled their square footage.
Mm.
And what is that? 150,000 in a mortgage payment is what?
$700.
$700. Yeah.
In that ballpark.
Yeah. So, I mean, you've got those two big opportunities. And,
Yeah.
People have questioned, I had one client who met with me and he was like, I want to buy a foreclosure. I want to buy a foreclosure house. Well, hardly, it was like a fractional percent. When I looked up on the market, it was like 0.025 of the market. And now when they've said they're not going to foreclose on anyone, right?
Right.
The market is still super stable because you've got such a demand from the marketplace. California built less new construction homes in 2019 than they did in 2018. So even if we have, less of a buyer pool, we still have a supply issue that has created a lot of different workarounds in the market where you can put granny shacks on postage stamp lots in mom and dad's backyard, right? So California's been trying to do a lot of different things, but I still think the demand is going to be there with housing. What do you have to say about that?
No, I think there's always like the typical first time home buyer, home is maybe 14 to 1,800 square foot and it's single story, 3-bedroom, 2-bath. Well, that's the most desirable house out there because more people can afford that house than any other house, right? So there's always more demand for the lower price houses than there are higher price houses. So sometimes you can sell at a premium and maybe if there's any weakness at all, if people think there's gonna be weakness, there'll be weakness in a higher amount, So yeah, that's what homeownership's about, paying down that mortgage and having that equity to bring forward into your next house. There's tons of opportunity for that.
Yeah. When my parents, my dad's an immigrant and he got his GED, went into the military, and he saved up money to buy rental properties. When my mom and dad were married, my mom was like 18, 19 years old. And when I've been raised in a playpen fixing up rentals. I've, spent my spring break putting down linoleum in a property, so it's been part of my life growing up. But I see a lot of people are, looking at infomercials and going, oh, $9.99, and this is how you make money in real estate. And I keep going back to the way to make money in real estate is to buy, to hold, to trade, and to pay off, right? Like eventually that's where you're getting. If there's not some, cassette tape that you can buy to do well in real estate, and especially in California, it's not very challenging to do well in real estate.
Right.
As a homeowner, right?
100%.
So, okay. So I had a question from Tiffany. Hey, Tiffany. She said, what are lenders going to expect for those that had to be on unemployment because of COVID, since there will be no proof of income?
That's a great question. So if you're currently not employed, you need to wait, right? I'm reading another one here, sorry. So but once you go back to work, like you're fine. If you're salaried and you get furloughed or you get laid off, it's okay. I wouldn't worry about it. Once you go back to work and you're stable, go for it. As long as you have the required down payment and everything else. The key is you really need to do what you can to avoid missing any payments because you don't want your credit score to drop. That's going to be the biggest thing that's going to hurt you to miss a payment. So I would even, if I had to, I would even reach out to mom or dad or grandma, grandpa, somebody. I would, like I said, I would borrow from a 401k. I would put something on a credit card before I missed a payment. And, but number one, never missing housing payments. And number two, trying not to miss a car or anything else, But I know that if you are laid off temporarily because of COVID, you're going to be fine when you're done. We already know that. Just get back to work. You're fine. As long as everything's the same. If you go back and your company says, oh, now you're going to be at 90% salary. well, then we just qualify you at 90% salary. That's it.
Yeah. And I'm seeing, I mean, there are situations where, they've bumped unemployment where you get an extra $600
Yes.
up until I think the end of July 31st. There is going to be a segment of the population that is going to make more money not working than working,
Yes.
right?
Yeah.
That because they got a pay boost
Yes.
with the stimulus package plus whatever handout, has come, or the stimulus payment.
100%. Hey, Catherine asked, I heard that banks don't like to see gifts when a house is being purchased, like gift funds are kind of like frowned upon. That I've never heard that. And I've done this for 15 years. Like gifts are 100% fine. Here's the funny thing about loans. Loans have guidelines. If you fit within the box, you're good. And it doesn't matter whether you personally don't think it's maybe, oh, it's not good to get a gift. Totally, they're fine. You can get a gift for a conventional loan. You can get a gift of whatever you want. I've seen people get gifts for $100,000, and 100% of your down payment and 100% of your closing cost can come from a gift, as long as you're doing a VA, an FHA, a conventional loan. Jumbo loans have a little bit different guidelines, but if you're jumbo loans, you're not normally getting a gift to cover all your down payment. But the gifts are totally cool.
Yeah,
I love gifts.
And
Go get a gift.
And also, if you're working in the upper tiers, right, and you've got 550 and above price point, I expect with the things that are going on, maybe temporarily or long term with the jumbo market, if you've got a seller that's being relocated out of state, or they have this motivating factor, or they're getting divorced, or they're more likely to give a credit, right, to that.
Yeah.
To that buyer. So I think we're going to see more credits on the higher end, and
Yes.
sellers a little bit more willing to negotiate on, repair issues, because, as an agent, we have a 2-stage negotiation process in our area. It's different in the Bay Area, but, we're doing price and terms at the initial stage of the contract, but then we still have our inspection contingency. We still have appraisal if it's not waived. And so I have to go in and do a second level negotiation on repairs mid-contract. And so I think, depending on motivation, you might see more willingness on those, on those higher end homes.
Yeah, and it depends when it comes. Like we had one right, I think it was last week it funded that we had the closing disclosure had gone out, docs were out, and the buyer just for some reason wasn't wiring his money. And we found out, well, he's a construction worker and they're working on a project that is deemed essential. It was a care home, but they sent him all home one day, and he got really nervous because I guess someone coughed on the job site, and so they sent him all home. And so he's like, I just don't know if I can do this. And so he actually sent in a request to cancel. And I said, well, like, is there anything what's the biggest fear you have? He's like, I know we're going to be fine long term, but just over the next couple of months, I'm afraid I won't be able to make my first couple of payments. And I said, well, why don't we go back to the seller and ask if they'll give you a credit equal to your first 2 payments? And we did, and he got it, and it closed. And so sellers don't want to, if they're motivated, they're listing their home right now, they're motivated, right? And so there's a reason they're listing it.
Or they're getting ahead of the flood, right?
Yeah.
So, I mean, some of it can be strategic. I mean,
Yeah.
if you've got the holy grail of real estate, you've got a single story with RV access, a big yard, and a pool, probably not going to get a lot of credits or whatever. I mean, that's like the real estate unicorn. But yeah, there are, if you're looking at a 3,200 square foot tract home in Lincoln, okay, well, there's a lot of those, right? That somebody might bump over to an next, or just pause and wait for it. The thing is we don't know what interest rates are going to be in August or September, or, and that, I mean, can just go through some of the, payment issues as interest rates rise.
Yeah. So like you're talking about like how much more it is, like so.
Yeah.
So every like percent increase in rate, you typically see like a 15% reduction in buying power. That's the bummer, right? So buying now when rates are low, even if rates go up later, like if you're buying a a $400,000 house, and maybe if rates go up 1%, then now you're looking at a $375,000 or $350,000 house, which would be, probably not, you're not gonna be too pumped about that, especially when the home values are probably gonna be going up over the next few months,
Yeah. Well, and you've got that thing where you've got clients that are looking at homes, at 500, and then interest rates go up. It's hard to slide back and look at homes at 425, right? It's like a world of difference every 50 grand. And in the lower price point, gosh, even, 20 grand is a world of difference. It's a bedroom. It's a better school district. It's, fundamental things. So you guys can post any questions on Facebook or in the Zoom chat. But what I tell clients all the time is that you don't pay a price for a house, you pay a payment every month, right? So if we've done our budget and we've looked at what this will cost at a higher interest rate, it's the payment in the end. And a lot of things, not just interest rate, affect payment. It could be the added tax in Melrose. I'll explain that to clients a lot. I'm like, this house with high Melrose, we could buy a house with no Melrose for $60,000 more, and it's going to be the exact same payment, right? So it's figuring out that payment amount and the comfort level there. Ken, what other questions? Let's see, I'm trying to sort through questions right now. What do you see as far as, the time that it takes to actually get pre-approved for a loan? What does that process look like? Like if someone wants to buy a home, what would that look like?
Pretty straightforward process. Typically what we do is we'll have a goal call. I think that the most important is to go in knowing exactly what a comfort zone is for a monthly payment, how long a person plans or a couple plans to live in a house, so we can help structure the right program for them. Because the right rate is cool, but the right plan is trumps rate every single time. So let's find out what loan you need to be in. Because whenever I meet with someone, it's always like, am I approved for a certain house, or how much am I approved for? And then what loan program is best for me? What's my monthly payment? And the corollary is always the breakdown of the principal, interest, taxes, insurance, and everything. And the last thing is how much money do I have to bring to closing? So we have that conversation up front of what their comfort zone is. That way, when they go out and look, if they start creeping up, because buying a home is an emotional process, and you start finding, oh, well, this home is at 400, and then oh my gosh, look at this one at 425, and the next thing you know, they're at 475. Well, do you know what the payment is on that? And are you going to love it at the end of the month as much as you do at the beginning of the month, right? So we have a quick phone call just to go over goals. We complete an online application, and it's a super easy AI-driven app that, as you answer the questions, it gives you a list of items that we need to underwrite you. I normally underwrite everyone ahead of time. It's free. There's no obligation. We do a quick credit consult if there's anything going on there with credit to help them boost their scores, to help them get the best rate. But we send them to underwriting. That way, when we make the offer, I'm a big fan of getting the first offer accepted. And like you mentioned earlier, it's not always the highest price that wins. It's always, what makes it attractive is some of the terms, like how fast can we close? Is there any loan contingency? And by underwriting them ahead of time, we have no loan contingency. And so that offer is like cash, and like on that one, we were talking about the nurse, boom, we didn't even need an appraisal. So no loan contingency, no appraisal contingency. All you're looking at is inspections, and it's the same as a cash offer. And so if we can close in 14 days, that seller knows that there's a less likelihood of something to go wrong, right? The longer you're in escrow, there's a bigger a chance that something's going to happen.
Yeah. Yeah. I mean, I'm a professional, and when we bought our house, I have a background, certified trust and financial advisor. I'm a real estate broker. The night after we closed on the house, I said, how are we going to afford this? What did we do? Right? Like even professionals, it's emotional for. And so if you can make that time period shorter and get it over with, but doing all of that front end stuff, because I'll get calls from people say, oh, you sold my Aunt Sally a house. There's this house I want to go meet you at, can you meet me there in 30 minutes? And I'm always like, Yeah, I can, but we're going to get you into a home faster. That's going to meet your needs better. If you come into the office and give me 2 hours and I can go over the California contract
Yeah.
with you, I can go over the 10 steps to an escrow, and we can talk through what your immediate need is in real estate and what, how long you're going to hold it for. Because I see people buy something too small for their lifestyle. And then a couple of years later and a couple of kids, and they have to move again, right?
Yeah.
And then you have to pay nice people like me to do it all for you again,
Yeah.
where if you had thought your process out more about where you wanted your kids to go to school, how long of a commute you want to have, and all of that stuff can be done in, an hour or two of actually sitting and having a conversation and figuring out those
Yeah.
needs and wants.
That's so huge. I've never actually heard someone talk about going through that much detail. And I think I kind of dumb lucked into my first house. And it was just like, I don't know, it just happened. And it was a great place. But I've seen so many people over the last 15 years buy, and then they're selling the house within a year or 2 years. And it's such a waste of emotional energy and equity, and also equity, like
Yeah,
real money. It's such a pain. I
yeah,
can't, yeah. So if you just thought a little bit more, thought it through, like what's the end goal, like begin with the end in mind, right? As
yeah,
Stephen Covey says. I was thinking earlier, helping someone get that first offer accepted to me is so huge. And I'm a huge fan of it because I've tracked it over the last 2.5 years. And if we can help someone get that first offer accepted, on average, we save them like $25,000. Because what happens is if you find a house, if you narrow all that, you're looking online and you're watching homes come and go, and then you narrow it down to like maybe 10 you want to go look at, or 3 or 4 or 5 you want to go look at it. You look at those 3 or 4 or 5 live, and then you make an offer on one. It had almost everything, all the boxes were ticked off, right? Or as many as you could possibly tick off in that price range. Well, if you don't get that offer accepted, you've already seen everything else in that price range. You don't want to buy them. Now you've seen this awesome home. So chances are, if you're looking at 400, say, now you're going to be looking at 425 to get the same thing as you got in that home that you could have gotten for 400. And if you couldn't offer a really quick close, you didn't have, your loan approval, you could, already done, whatever you need to put in place to make it more attractive to the seller. If you didn't have it, then you're going to spend more on the home next time.
yeah. And I see that with clients like if they're an existing client of mine and I have that trust, because I'll tell people don't buy that home. I tell them people don't buy a home more than I tell them to buy a home, right? But if they don't have that level of trust from me, they haven't dealt with me before, whatever, they kind of get kicked in the nuts for a while, right? In the multiple offer situation. They
Nice.
don't offer strong enough to get it,
Yeah.
right? And then they get kicked around the market enough that then they just kind of start throwing high numbers because they're just
Oh,
exhausted from the process to get the house. And I'm like, if we can be the top one where they're not countering 4 people, and
yes.
we can have no loan contingency and be no appraisal and be really tight on our terms and close in 2 weeks and this can be over with, you're gonna be able to get something so much quicker. And I teach a class once a month for newer agents or agents that are trying to brush up on their skills, and I'll hear time and time again of, oh my gosh, I just can't find this buyer house or whatever. And I'll get people referred to me after being kicked around the market for a couple of months and said, oh well, and I say, oh well, tell me what you were writing in the offers, can I see what the other agent was telling you to do. And it's 21-day loan contingency, 17-day inspection contingency. We're going to ask for a huge credit back. I'm going to
Walter
put
Wilson's
very,
right.
yeah, I mean, it is like, I want 3% back. I had one
Yeah.
client that I asked him, I said, are you guys actually trying to get a house? And they're like, yeah, we have. Like, we've been actively looking for 6 months. I said, as a listing agent, what I'm looking at here to me would speak of a buyer that doesn't really care if they get this house or not, right?
Mm,
And so, we're not overpaying for the house or whatever, but we're, trying to get picked
yeah.
first, right? And all that. So, okay, let me just check the comments to see what, do we have anything that we talked about before, Ken, that we should cover?
Yeah, I think like, I think a lot of people's questions that I've heard are fielded over the last, few days. We have like, it's like 6:55, so I'm guessing we have like 5 minutes left. If
Yeah.
you have something you want to ask us, get it in real quick. But just final thoughts. I think, like looking over, is there opportunity? And is this the right time to buy? That's always everyone's question. What are home prices doing? Is it a good time to buy? Is it a good time to sell? And I just think that, look, don't let this disrupt your plans. We're going to be back to normal. I think obviously I'm not an economist, but I think we're going to be back to normal this summer. And so if you are in a space where you want to move because you want to be in a certain school district, move. It's the right time. If you have kids leaving, they're off to college. Now they might be back temporarily, but they're going to be gone again. If you want to move and downsize, downsize. Like moves should be governed by major life events that go on in your life and your desires that fit within your overall wealth plan. So don't let this disrupt what you're going to do. There are pockets of opportunity right now. There may be some people that may need to wait. I would contact Peggy and just say, hey, genuinely tell me your thoughts of what I should do. Give me your opinion. And I promise you, she has your best interest at heart. There are people that can buy right now, and they should. If you have the ability to buy and you can find the right house, I personally think it's a great time to buy. If you're nervous about your job situation, hold off by all means. But if you're not and you're gainfully employed right now, go for it. It's a great time.
Yeah, I would say too, with not everybody moves because they're moving up in the market or moving down in the market. They've got some sort of lifestyle change that's dictating whether they're going to move or not. So I'll often have clients that say, "Oh, well, I want to sell at the at the height." And I'm like, well, we don't know when that is going to happen. But if you're selling and you're buying in the same marketplace, it's like monopoly money. It does not make a difference, right? The only people that get hurt in markets are those first entry level people, which the affordability factor for first time home buyer homes compared to California rental rates, which are stupid high right now. I just don't see people losing. And if they, for whatever reason, wanted to sell it, I might even buy it as a rental, for one of my clients. So I just don't see a lot. Now at the very high end, there may be some people pausing from, that perspective, but the financial planner side of me, and I have been through layoffs and downturns in the market. I can remember, I thought it was a great idea to leave my great corporate job in Palo Alto and become self-employed. Real estate seems so fun and easy, and it has been fun, but it has not been easy. And when we had our second child, Tilly, she is now 10 or 11, I don't know, but worst part of the real estate recession, I was 7 months pregnant, my brother died, and my husband got laid off from his job. So I have and being self-employed as a realtor during the worst downturn in the real estate market. And so my advice to you, if you're feeling the crunch financially and you've got those things, when all of that happened with my husband, when he came home with the pink slip or whatever, we sat down and we did hard cuts fast. Because that's going to give you the longest time and the least amount of stress. And so when this shelter in place, I have a lot more time on my hands besides helping with my husband to homeschool, but not dropping everything to show property when we were non-essential. I got our last 2 months bank statements and I looked over everything. I'm like, oh, I subscribed to the Hallmark Channel during the Christmas season and I never canceled the $6, right? But it's that latte effect, right? I went through, I'm like, oh, the Wall Street Journal, I don't even read that enough to spend $40 a month. And I just started slashing all of the stuff from the budget. And I heard David, or not David Bach, is another author that I was on a call with who wrote Profits First. He said, if you have like a credit card that you have all these like auto pay things, your apps on whatever, just call up and tell them that you lost your card. So all of those people that are auto debiting your card for different things will be reaching out to you, and then you can lazily decide whether you still want that service or not. And there's a lot of ways to save money during this economy. I mean, you're going to see your insurance on your car. The California Insurance Commissioner has deemed that they need to refund you some of the premiums that you paid during this shelter in place. And you're seeing, credit card companies, if you do have a payment, to call and to get those rates negotiated. So there's a lot of ways, and now people hopefully have time to actually look at their budget and slash it. And the best app that I found that's free and that I actually use with our family is called Mint. And if you link in all of your bank accounts, it will put it into a pie graph. And if you haven't been tracking it, and there'll be a little time that you'll be choking and like, how did we spend that much on food? And when you're from a large family, you'll understand that's the thing that will get our budget. Yeah, where did it all go? But just weathering the storm, if you do have income loss, get hardcore drastic. I mean, we cut our expenses 20%. I mean, part of it is I'm not driving and spending $600 in gas a month, but we were able to cut it down, and we're obviously not doing much except for playing board games. And
you're not buying clothes, you're not eating out. There's so many things we're not doing. I'm like, I think we save more money this month than we ever have, because it's like we're not getting out and doing things, right?
Yeah. Well, and also, I mean, people are spending.
Shut down, thank God.
Yeah, but people are spending so much time in their homes now that I think they're looking like, oh gosh, boy, wouldn't it be nice if we had a house with a pool, and that money that we spent at Chipotle could be the price difference in a payment, right? Okay, can we not do Chipotle once a week, and we can move up in the market and get a house with a pool? So I think you'll see a lot of people that are sheltered in place and realizing that their place is not what they would want it to be, right? So well, all right.
This was awesome.
Thank you, Ken. I could talk about real estate all day long, but I want to thank you. I was reading a study. These two scientists in Virginia talked about, when a person looks at a mountain by themselves versus if they're climbing the mountain with someone else, they estimate that the height of the mountain when they're doing it with someone else is 20% less than if they're doing it by themselves. Exact same mountain. And I want to thank you, because when I'm offering on properties, that mountain is so much shorter when you are there to help partner with me to get offers accepted. And likewise, I feel the same way with clients when they call and have a confidential conversation with us, and we hear it all. We hear last year I did 9 divorces. I do a lot of people pass away. It's not all happy moves, but it's all, my favorite line from our, when the real estate market tanked, I was volunteering at my kids' preschool, and Bev Boss, who's no longer with us, when a kid got upset, she would get down and say, we'll get through this. And, that's the case with clients. Like we're here to partner with them to make that mountain shorter, to give some expertise, but also to help strategize with you about what's the best, way to get out of a situation or to get what you need. So I appreciate your partnership and your willingness to leave your 3 kids and your adorable wife, and your kids are probably not fed right now, or
I think they might be because she came home, but luckily I've got a really short commute back to the house.
I know, isn't that something? It's the best part of this shelter in place. So all right, well, thank you, Ken. I appreciate it. Take care.
Have a wonderful evening.
You too. Bye.
All right, see ya.